Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. So, tariff man or art of the deal? There's been much debate about which way President Trump will lean in the first few weeks and months of his presidency. This week, of course, tariffs took center stage. But for financial markets, the question is how much of this is already in the price. And of course, in Asia, the question is whether the DeepSeek announcement can help Chinese equities extend their gains and overcome tariff concerns. So, how do investors position around these events? To discuss this, I'm joined by Rajat Bhattacharya, who's the senior investment strategist at the CIO office. So, welcome, Rajat. Thanks for joining us today. So, Trump's tariffs announcement, what would you make of the announcement so far?
Thanks, Manpreet. Yeah, just past couple of weeks, obviously, Trump has been in the limelight. So when assessing Trump's policies, we may need to look at his various motivations which inform them. So Trump calls himself, as we know, the tariff man. He extols the virtues of protectionist duties to tackle US economic and social challenges. He's also, by the way, the author of the 1980s bestseller, The Art of the Deal, which provides insight into the way he thinks about business deal making. Now, for investors, assessing which of the two facets of the US president will dominate his second term is important. His first 2 weeks suggests tariffs will play a more prominent role this time, likely increasing market turbulence this year versus, let's say, last year. Although markets are likely to eventually restrain his ambitious agenda, rising uncertainty reinforces the need to maintain a diversified foundation allocation with a preference for US assets and gold. Alternative assets such as private equity and debt and real estate, thanks to their historically low correlation with equities and bonds, should also help reduce portfolio volatility.
Thanks, Rajat, for that broader overview. But perhaps to get a little more granular, could you help walk our listeners through, what specifically has happened so far and what that means for their investment decisions?
Sure. So the US president, after indicating on his inauguration day on 20th Jan that he may go soft on tariffs, ended up imposing stiffer than expected 25% import duties on Canada and Mexico. He then postponed the duties for a month after speaking to the respective heads of government and after his counterparts pledged tighter border controls. Trump also imposed additional 10% tariff on imports from China, which still stands. And that those tariffs actually double the average tariff rate on China to almost 20%. Now, China has retaliated with targeted tariffs and has started antitrust investigations on some US technology sector leaders. Meanwhile, Europe's leaders have been warned stiff tariffs are coming. Now, US trading partners are more vulnerable today or to US tariffs compared with Trump's first, Trump administration, as the size of the US trade deficit has almost doubled since the start of the pandemic and since Trump's first administration. And this deficit has been led by deficits with EU and Mexico. Almost a third of Mexico's GDP and a fifth of Canada's GDP and almost a fifth of EU's global exports come from exports to the US today. This gives the US president more leverage to use tariffs as a powerful negotiating tool to extract concessions. This is consistent with our overweight stance on US assets within our portfolios.
On the tariffs, do you see them as being likely permanent, or does Trump face any constraints on just how far he can go?
So that's an interesting question, right? Unlike Trump's first term, tariff proceeds are likely to be a key component of funding proposed tax cuts in this administration. Investors are waiting for Treasury Secretary Scott Bessent who's a proponent of measured tariffs, to lay out his tax cut plans. Elon Musk's ability to cut government spending will also determine how much taxes can be cut without unsettling the bond markets. An ambitious program to deliver most of Trump's tax cut promises made during the election would require tariffs to be more widely used and be longer lasting. Now, in terms of the constraint, the main constraint, in our view, is Mr. Market. Trump's quick reversal on Canada and Mexico tariffs after US equities sagged last week suggests markets are likely to remain vital constraints on Trump's policies. Almost 40% of S&P 500 index companies revenues and almost 57% of technology sector revenues are sourced from abroad, leaving them exposed to trade disruptions. While this should give investors some assurance against extreme policies, it emphasizes the need to balance traditional portfolios with gold and alternative assets to moderate volatility.
Thanks. I think that transitions quite nicely to what I want to talk about next on the diversification side, which is gold. It's obviously risen to new record highs. In your view, what's driving that, and can it really extend?
Yeah, gold has actually risen 9% this year after a stellar performance last year. That makes it the best performing asset class, not just on this year to date, but also over the last 12 months. If the announced tariffs against Canada, Mexico, and China stand, the effective US tariff rate will soar to 10%, the highest since 1946, from around 2 to 2.3% currently. Now, studies show tariffs boost short term inflation but hurt medium term growth. Using Fed models from Trump's first term, Bloomberg Economics has, for instance, estimated the proposed tariffs, if they are fully passed through to consumers, could lift US core inflation by almost 0.7% and cut US GDP by 1 to 2%, 1.2%. However, supply disruptions, especially in the autos and energy sectors, and retaliation from trade partners, and of course, dollar appreciation means the actual impact could vary significantly. The uncertainty is likely to keep the Fed on hold for now, and this is why an asset class, a safe and haven asset class such as gold, is likely to remain well bid.
Okay, and then finally moving on to China. I mean, on the tariff discussion specifically, I mean, what do you see as the implication for Chinese policy?
China is likely to counter this tariff with fiscal stimulus. I think we should expect some stimulus coming through in the next few weeks. Now, the additional 10% tariff on China is likely to directly reduce its GDP growth by about zero point 0.5 percentage points, but the indirect impact is likely to be greater. Although China has reduced its direct exposure to US via exports in recent years, it is more reliant today on global trade than, let's say, even 5 or 10 years ago. It also faces deflation challenges at home. So, given all that backdrop, we expect Beijing to ease fiscal and monetary policy in coming up with this March National People's Congress probably being the next milestone, and that should help counter the impact of US tariffs. Now, authorities have kept the Chinese currency, stable through daily FX fixing, which also sustains the possibility of a trade deal with the US.
All right, and finally, before we run out of time, maybe just on DeepSeek, that was the other major development. I mean, what do you see as the implication of the DeepSeek announcement on global equities, but also on China's technology sector?
Yeah, the emergence of DeepSeek, the low cost alternative to OpenAI, has profound implications in our view for the global technology investing. It will lead to companies emphasizing the efficiency of AI investments, demanding more bang for their buck, and then large cloud service providers are likely to remain aggressive with AI spend, though the mix may change. They will likely require more efficient chips as they accelerate AI adoption and the development of higher end areas. We believe this is going to increase the size of the pie in the AI industry, which is positive for the long term. And this is why we maintain our stance on buying on dips, the broader US technology and communication services sector. Overall, we remain overweight US equities, especially with US companies delivering yet another season of strong earnings beats in Q4. So for the S&P 500, 5,800 is a key support level, followed by 5,650. However, in the near term, there's likely to be volatility ahead in specific industries and subsectors.
All right. Well, I think that brings us to the end of the time we have available today. So we'll close the conversation. Thanks very much, as always, Rajat, for taking the time to speak to us. If I can summarize our top takeaways from today's conversation, I think number one is, of course, the importance of staying diversified. While long-term fundamentals, of course, favor equities in our view, the diversification is important to ride the tariff volatility. The second point, of course, to stay overweight gold, which we expect to continue to be well bid amid the tariff announcements, inflation, and of course, long term central bank buying. And finally, deep seek capturing the headlines, but we think obviously these sort of announcements and advances tend to expand the pie. So we'd be happy to buy the dip in the technology sector. Thanks very much for listeners for joining us today. We hope you enjoyed the conversation, found it insightful, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.